Hi, I'm Lee Stone and this is your UFX Bank Week in Review. Let's begin the day by taking a look at the last week's risers and fallers. The euro continued its momentum and posted another positive week versus the dollar. The euro last traded at 139.73 for a gain of 0.32% on the week. The British pound had a mixed performance against the dollar. Still, the pound managed to finish the week on a positive note, gaining 0.18% and last trading at 159.84. The dollar continues to fall versus the yen in steady drops. The dollar managed just one day in the green, moving down 0.78% for the week. The pair was last trading at 81.43. The loonie had a mixed week versus the dollar, finishing almost unchanged, last trading at 101.16. After 3 consecutive weeks of positive returns, oil fell 1.7% this last week to close at $81.25 a barrel. Gold, on the other hand, continues to bring in solid returns week in and week out. The precious metal was last trading at $1,368 per ounce for a gain of 1.6% on the week. In news, the US dollar continued to drop across the board this week, reaching parity with the Australian and Canadian dollars, and falling to a 15-year low versus the yen. Fed Chairman Ben Bernanke spoke on Friday and indicated that quantitative easing measures were likely to continue. The big news this week came at the end of the week, when it was announced that the U.S. will delay a report on international currencies until after the meeting between the group of 20 nations. The reason for the move is most likely to do with China's yuan. To understand this better, though, let's discuss it with analyst Martin Smith. Hi, Martin. How are you?
Thank you, Lee.
So we've talked about the yuan or the renminbi before, but for our viewers who've may have missed this, can you give us sort of a background of the situation?
Yeah, certainly. The crux of the issue at hand is that many nations have accused China of holding back the value of its currency. Now, you might well ask, why would a country want to do this? Well, the reason is rather simple. China is the second largest exporter in the world, and by keeping costs low for foreign importers who are purchasing goods, China is able to keep demand for their goods higher than the demand for goods from other nations. In the process, it has had significantly adverse effects on economies of other exporting nations, like Japan, for example, whom we talked about in detail before. What this is doing is causing other emerging economies from allowing their currencies to appreciate as well, in order to remain competitive, of course. Now, all of this is limiting global growth and prolonging the global economic recovery.
So, it seems like the U.S. is leading the charge in this whole situation here. Why then would they delay the report?
Well, indeed, the U.S. has been the most vocal critic of China in regard to this matter. U.S. exports have had a significant turn downwards as a result of decreased demand from U.S. exporters. And in fact, if you recall, we talked about the U.S. House of Representatives having passed a bill that would allow for the levy of additional duties or tariffs on goods from China. The measure has yet to be approved in the Senate, but it did send a strong message. And in June, China announced that it was removing its peg to the dollar. Now, since June the 19th, the renminbi has appreciated roughly 3% and increased its pace in September. Now, if China maintains a 1% per month increase on the value of its currency, this could significantly help to resolve some of the trade imbalance between nations, especially between the US and China. The delay in the report could be for a number of reasons. One reason would be to give China further opportunity to bring the currency back in line with estimates. To give you a better idea of the situation, current estimates have the yuan undervalued by as much as 40%. Now, another reason for the delay would be because of uncertainty as to what China might do once the G20 meetings are over. Some believe that China is only posturing before the meeting, and then afterwards they'll return to earlier policies of manipulating currency values. I expect China to keep this up at least until the G20 meetings, and I expect the US report to be somewhat critical of earlier policies by China, but to praise them for actions over the last few months. What, of course, will happen afterwards, well, that's anybody's guess.
All right, thank you for that. Let's go now then to our Ask the Broker segment. Our question of the day comes from Michael Tesla of Long Beach, California, who writes, I'm new to Forex, and I was wondering how pips are calculated.
Well, the basic calculation is that for most pairs, that is, a pip's worth 0.0001 of the secondary currency. In Forex, the value of each pip is based on the size of the position you've opened. Let's say you've purchased 100,000 euros and you're selling dollars. Well, since every pip is worth 0.0001 of the secondary currency, then every pip would be worth $10. To clarify this further, let's say we bought 100,000 euro dollars at the rate of 138.02, and the pair went up to 139.02, or 100 pips. Then we've made $1,000. Keep in mind, though, the rules change based on currency. For example, when trading the dollar yen, the Japanese yen is the secondary currency, but in this case, because the yen works on a different scale than other currencies, each pip is worth 0.01. Remember, though, most Forex brokers offer pip calculators, which can help you in figuring this sort of thing out.
Thank you very much, Martin. We hope you enjoyed our weekly review, and we hope you will join us next week. Until next time, be sure to visit us at UFXBank.com for simple, safe, and secure trading. Also, you can follow us on Twitter and Facebook. To submit questions to our weekly broadcast, please email your questions to Martin Smith at askthebroker@UFXBank.com. For UFX Bank, I'm Lee Stone. Good luck and happy trading.